this particular segment gives us an opportunity to get you the voices of the people that manage your money. My next guest is Raunak Onkar, the research head and the co-fund manager of Parag Parikh Flexi Cap Fund. Thank you so much, Raunak, for taking the time. It's a pleasure speaking with you. And I think the first conversation that we had today sets up the first question for me very nicely, because we've discussed fund manager approaches. So let's start by trying to understand how you approach investing. What is your philosophy of managing funds? And how does Parag Parikh Flexi Cap Fund operate? What's the philosophy?
Thank you so much, for Alex, for having me on the show. Good evening to your audience as well. So our approach of investing is actually quite traditional. You can call it the value investing approach of finding businesses and ideas to invest in. So the whole philosophy sounds very simple, but it sometimes becomes very hard to find exact ideas which fit in within that philosophy. So it's essentially finding companies who are run by credible management, good quality promoters own them, and the alignment of interests is there within the people who are managing those companies and the minority shareholders. Secondly, the business model has to be very good. The companies should be able to demonstrate long-term performance over different cycles, which is above average return on capital generated over a long period of time. And that is sometimes very useful to see the company's capital allocation decision over a long period of the operations. And thirdly, and the most important in today's context, will be the valuations that we pay for these two kind of companies we like. So if it's run by good people, if it is a good business to own, it should be available at a reasonable valuation, and it should not be available at a very exorbitant or expensive valuation. So these are the three main pillars with which we think about finding and filtering our ideas in the investment universe. And as far as the Parag Parikh Flexi Cap Fund goes, we approach it as a go anywhere fund. The whole idea behind the Flexi Cap Fund was to create a go anywhere kind of an investment vehicle, which can go across different sectors, across different sizes of companies, and also in this particular case across geographies. So we cannot restrict ourselves to investing only in our home market, but we also choose international companies to invest in, because value can be available anywhere. Good companies can be available anywhere. And if we have the opportunity of owning them, if we like the business and we think the long-term prospects are good, I think we should not be hamstrung by the opportunity that the fund cannot go there. So the fund was designed to take advantage of all these opportunities.
And that is evident, Raunak, in the kind of asset allocation that you have in the geographical split, where you say that the US equity holding is 30% of the fund and non-US is pretty much about 67%. I'm just trying to understand, though, the kind of run that we've seen, and I'm taking from the third pillar that you mentioned, which is valuations. How are you seeing that right now? Because the run that we've seen since the crash in early 2020 has been incredible. So I'm talking about incremental investments from here on. How do you manage that?
So the thing about valuation is when there is a certain aspect or certain area of the market where the valuation is too high, sometimes you will find opportunities in some other area of the market where the valuation isn't too high. So from our perspective, when we look at valuations across the board in India as well as globally, clearly the valuations are a little bit stretched. And the last year's numbers, which are the year-on-year results that companies are displaying right now, may not be very indicative of the long-term earnings potential. We have seen a knee-jerk growth in many industries, or even sudden drop of earnings in many industries. They may not be representative of the longer-term trends of all these industries. So if you look at valuations, we have to look at it from this context, that filter the companies which have had a sudden shock and now are recovering, filter the companies which had disproportionate benefits from having the pandemic lock everyone in our homes. And these kind of businesses have to be differentiated, and then we can look at valuations in that context. And also on top of that, if the longer term growth rates are still sustainable, if they are still reasonable, then the valuation should be seen from that filter as well. So if you see many companies, the valuations, I agree with you, are not very, very attractive. They were attractive last year when the market had fallen, and it was attractive till the end of the year. But suddenly there was a surge in valuations in many sectors across the board. So it's very difficult to find incrementally great ideas to put new money in. But some of the existing areas and some areas which I said, like if there is overvaluation in one side, there might be undervaluation or reasonable valuation available in some other area of the market. We are finding those sectors appealing at the moment.
Okay, very interesting. And I know that you're a student of various sectors and you study things very, very closely. Raunak, I'm just trying to understand what you've seen in the tech space. You've got a substantial allocation towards the sector, 90 odd percent, and you're holding quite a few major companies. But over the last couple of years, what dramatic shift have you seen? Because I know that your approach also is to find companies with a very strong moat. So what are you seeing develop there?
So mostly when people talk about tech, it gets painted with a very broad brush of technology sector. But in technology, there are several baskets of sectors available. One is the sectors we are very familiar as Indians, which is the IT services industry. And that industry has had a long runway of growth over a long period of time. So we have seen several cycles of IT sector growth in the past 25, 30 years, where as different technologies have come, IT services companies have adopted and have created solutions for their customers across various verticals. So that growth has still been there. There's another aspect of technology, which is new technology that comes in, where because of the internet, a lot of technology enablement happens across different sectors. So advertising sector got an overhaul where digital advertising came in because of the internet. Retail space got an overhaul when e-commerce started as internet allowed people to purchase stuff online. And there are several other categories like the tool that we are using to chat right now. It's a conferencing tool, which otherwise people would have shunned from using, but now it's a go-to default tool for any meeting that we want to set. So there are a lot of enabled technologies that have entered into our lives over the past several years. It's not a very short-term trend. Whereas this trend got a little amplified last year because some of these tech tools were available. And fortunately, we also had great internet connectivity available in many developed parts and even developing urban areas of the world. And because of which we were able to connect and continue our work in many of these areas and jobs which were enabled by these technologies. So I think that is a stark difference that I've seen. And to be very honest, I was surprised by the sudden bounce in terms of technology adoption across several sectors and several verticals.
So the other thing, of course, is the way that inventories are being managed, supply chains are being managed, right? Because I know that you study the semiconductor crisis also very closely. Are there any opportunities in the way that people have shifted, in that people have shifted seemingly from just in time to just in case? That's what everyone seems to be talking about right now. Does that change the opportunities available, or do you think it will settle down?
See, in the short term, when there was supply chain crunch or even a disruption happens in any critical component ecosystem, then I think people will make a short term scramble to pick up whatever tactical thing that they have to do in order to survive and maintain production levels. And in many cases where many companies were not lucky to find a tactical solution at that time, they had to even resort to shutting down their plants for a few days a month or even longer durations also, unfortunately. So we have to see that shorter term adoptions need not represent longer term trends. So it remains to be seen as the supply chain then comes back to normal. We don't know when it will happen. In many places, we have seen the logistics cost going very high, because of which people are hesitant. In many cases, people are seeing there are port delays, because of which there are delays. And factories are working across the globe, but the stuff cannot be shipped at different places, because of which there is delay. So these are temporary and seem like shorter term issues. Maybe medium term to longer term, we have to see how companies adapt, how their balance sheets adapt, how many of them have the capability to use working capital judiciously to go from, say, a just-in-time to a longer duration or longer inventory hold, and what that does to product life cycles, new upgrades and features in new products. That remains to be seen. So I don't want to extrapolate a shorter-term trend or a shorter shock to the supply chain and consider that to be a longer-term trend.
Raunak, we were having a really insightful, engaging conversation. I do want to ask you, though, the kind of returns that we've seen that you have been able to achieve over the last year or so, one could call them supernormal. Overall, do you think that investors should temper their expectations going forward? Or going by what you said in terms of the availability of value in all cycles, do you think that it's reasonable to expect strong earnings even in this scenario at valuations where they are?
So certainly investors, since we have seen a very sharp up move after a very sharp down move, the temptation is to extrapolate a shorter term trend, and we might want to feel positive about the future because everything is opening up. We will probably try to overlook some of the macro issues that are there, or even the pandemic, which still is supposed to be out there. That might have an impact going ahead. We don't know that. We did not know it in the second wave. We didn't know it in the first wave. The only thing is we know for sure that most people are getting vaccinated. Trade is their activities that we can see traffic on the road, which is a good sign that economic activity has come back. But that doesn't mean we can extrapolate that to growth in profitability or sustainable growth in profitability. Because market will usually look at forward performance, and if we are guiding that with current valuation levels, saying that it's going to continue to do that over a long period of time, that may be a little bit too early to say. So I would say it's definitely better to temper your expectations, probably reduce a little bit of your profit extrapolation that people would have done, just to make sense that, okay, this is not a normal cycle. This is actually a very strange cycle which happened because of a global event. If it was a cyclical downturn in a specific industry, then we can understand that longer term trends do apply. But here we don't have a statistical basis to say that it's going to be continued going ahead as well.
But there are certain themes that have started playing out, Raunak, that will, in all probability, be very long term, right, in nature. I'm speaking here about ESG. How is that going to affect the construction of your portfolio? Are you already paying very close attention to that?
So I think ESG as a theme has been around even before we got into the pandemic or something like that. So it's been a longer term discussion, and most companies are now made to disclose their ESG efforts via their public filings. And I think we defer our judgment to most companies. So when we filter, we do want companies who follow good practices across ESG. But if you look at a company's own efforts, it has to be seen over a period of time. It cannot be seen that, okay, this year this company would have not done enough, so this company doesn't deserve the ESG label or something like that. And ESG, again, across different sectors, there are different metrics for how ESG is calculated. So we do keep a track on companies' performance and companies' ability to look at these factors and decide according to these factors. But that is only one of the data points we consider when we look at companies to invest in.
Speaking about the companies that you invest in, and I was curious because I was looking at your top 10 holdings, and the second highest is Bajaj Holdings and Investments. And I was just trying to understand the philosophy here, because I've heard people say that holding companies are not preferred to the underlying asset. And considering that Bajaj Holdings holds significant stake in Bajaj Finance and Bajaj Auto, how does this fit in?
So there are two parts to the answer. One part is holding companies in India are a little bit strange. There are some holding companies where the discount to underlying is substantially large, and there are some holding companies where discount to underlying holdings is actually not that great. The discount is very narrow. And that is a mystery because most of the companies should be at par if the capital allocation is just going to flow through from the underlying companies to the holding company, which is also listed. In case of the Bajaj holding that we have as a portfolio investment, we did want to invest in auto and finance of Bajaj Group, but we thought that this is a better way of doing it because we're getting that same asset at a 50 to 60% discount. And we, as the holding company, ends up getting dividend from both these entities. The dividend per share is a little better for Bajaj Holdings. But the whole idea behind having a holding company is not to just play on that discount, but if you like the underlying businesses, this is a better way to hold the underlying business at a discount than buying the underlying companies directly in the portfolio.
Fascinating. It's been a pleasure speaking with you, Raunak, and I hope to touch base with you real soon because I think that our conversations are always insightful. Pleasure speaking with you.
Thank you. Likewise, Alex.